Good morning. Welcome to Trading Hour. I'm Reema Tendulkar with Mia Sonia Shenoy and Pavitra Pari. Good morning, girls. It's a down day for our markets. The Nifty sold off about 125 points as we speak, but still holding on to that 18,000 mark. The mid-cap index is yet to find a bottom. Pull up the intraday chart of the mid-cap index and you would see it's fallen close to about 300 points from the top of the trading session. We're at the lows for the mid-cap index. Today, the banks are not outperforming. They're falling in step with the frontliners. The mid-cap index down 350 points. The PSU banking index too. After a nearly 10% up move in the month of November, today the PSU banking index is down close to about 1.2%. So profit booking kicking in the PSU banking space. Pull up the intraday chart of the the Nifty PSU banking space. The global backdrop is subdued. Hang Seng, Taiwan, Nikkei, all of them down between 1 to 2% as we speak. The Chinese markets too are down about 0.5%. The fallout of the crypto markets, the impact that it has on tech equities is also weighing on the risk sentiment. And that's one of the reasons why the dollar index has seen an inch up to levels back above that 110 mark. Remember, we had dipped below that level in yesterday's trade. So consequently, all that is weighing on the markets. Good morning, girls.
Hi, good morning. I think there's so much happening, right? I mean, the rest of the day is going to be taken over by the match. India versus England starts at 1:30. So I don't know too many
someone's
traders
watching our show right now, right? Imagine 1:30 p.m. onwards.
I don't think even we are going to be watching the markets 1:30 onwards. There's so much action there. Just hope it's not a washout because Adelaide has a cloud cover is what I read last. So, but yes, for the market, I mean, it looks like a bit of a washout for the bulls. The only thing is that it's not as bad as perhaps what some global markets threw up, right? So this has been a buy on dips market. The dips have not been bought just yet. But at least after the initial selling pressure, it hasn't gotten any worse. Yeah. I think the bulls would like that.
Oh, absolutely. Like you said, I mean, we've held above that 18,000 mark. So for now, there are cuts coming through, but it's much less in contrast to what we saw in the US and in some of the Asian markets as well. In addition to the PSU banks that Reema mentioned, some of the auto stocks also under pressure today. So a few of those will come up. Tata Motors, of course, on earnings, and then the rest of them are also up on your screen. In terms of cues to track, we do have that big US CPI figure which will come through. That will be an important cue. Also take a look at Brent prices. We have seen a move lower to 92. So it's important to see how that moves. And of course, the crypto market action will be closely watched as well. But let's talk about some individual stocks which are in focus today and reacting to their earnings. Tata Motors, like I said, is one of them. Lupin is the other one that we are tracking. So let's actually talk about both of those. Sonia, take us through Tata Motors. It is the top loser on the Nifty. So everything that went wrong there.
So, I thought, let me just drill it down to the 5 reasons why Tata Motors is down 5%, right? If you just look at the core numbers, there are a lot of data points, but mainly you have a big loss that Tata Motors has posted. The expectation was that there could be a profit this time around, so that is a bit of a disappointment. Of course, compared to last year, the losses have narrowed, but that's also because of a low base, because there was a semiconductor shortage issue last year, so it's really not comparable. If you look at JLR itself, it reported a negative free cash flow of £15 million, and the company said that that's because of the adverse working capital movement. JLR has also gone ahead and lowered its guidance for the full year for FY23. They say that the EBIT margins will now be positive. So that's a blanket statement. But earlier they had guided for a 5% EBIT margin in Q1. That's perhaps because of the global challenges. And that's something that's not gone down well with the street. Also, the debt has risen quite a bit, and that's a worry point for me. Almost 60,000 crores of debt on the books of Tata Motors now, compared to 48,700 crores at the end of FY22. And finally, the company has also cut its free cash flow guidance. So earlier, they had said that there would be a £1 billion free cash flow by the end of the year. And now they are saying they expect a free cash flow break even. So in that sense, they are cautious. They say that the global challenges exist. A lot of brokerages have gone ahead and cut their target price as well. And that's the reason the stock is under pressure today.
So I think there's the fact that the debt has gone up and even the free cash flow guidance has come down. Would it not get the investors to start questioning whether Tata Motors will be able to become net automotive debt-free? Remember, Chandra has been talking about that, the company will become debt-free by 2025 or FY24. But now, given the fact that there are issues in Europe, China itself is also under concern. And even in these numbers, in this quarter's numbers, free cash flow guidance brought down, net debt has gone up. I think people will start questioning
You know,
that,
it's
right?
very interesting you point that out, because IIFL put out a very interesting piece this morning where they say it's been a lost decade for Tata Motors, investors, right? If you look at it in the last 10 years, we can't pull up a 10-year chart, but I'll tell you the data. It's a negative 1% compounded growth for dollar investors. It's a 9% absolute decline, stock price, in the last 10 years. And it's a 5% compounded growth for INR investors. So the loss that Tata Motors reported way back in 2009 was also 3,000 crores. And this time as well, the losses continue. It's expected to report a 3,000 crore loss even in 2023. So from 2009, where they had a loss of 3,000 crores, once again 3,000 crore loss in 2023. Neither has the company gone anywhere in terms of profitability, and neither has the stock. So very interesting data point put out by IIFL.
Okay, but I think the street is betting on the EV picture and the fact that Tata Motors does have dominance in the EV market in India. But I guess that will take some time before it becomes a big contributor to their overall sales as well as valuations. But let's talk about Lupin. That's surging in trade. Lupin has been an underperformer, but this quarter there has been a significant 31% increase in the US sales, boosting the margins, and that's the reason why the stock is excited. Ekta is here to get us more details. Ekta.
Well, largely an inline set of numbers, you would say, for Lupin, but they came through when it came to their Q-on-Q recovery in terms of margins as well as the US business, and that's what the street likes. So the revenue was flat, and the street was expecting a flat performance this time. The key highlight, like I mentioned, were the margins, which improved to close to 11-odd%. Street was anticipating around 10.7% in the previous quarter, and this is versus around 6% that they reported in the previous quarter. So rather 10.7% was the estimate, 6% was what they reported in Q1 of FY23. US sales came in better than expectations, so $159 million versus estimates of $155 million, and versus a low of $121 million that they hit last quarter. Profit, yes, it was below expectations, but the street is just squarely focused on the margins as well as the US business this time round. India was sluggish, so that was one of the pain points this quarter. So the India business was up only around 3-odd%, and it has been quite a volatile business in the past couple of quarters. Now, in terms of guidance and triggers, would be, for example, the margins probably improving from here on to levels of, say, maybe a 17 to 18% exit run rate for Q4, something that the management had spoken about earlier. Plus, as well as the US business probably picking up further pace, sustaining at these levels, and maybe hitting that $200 million revenue mark on a quarterly basis. And overall, key launches such as Spiriva generic, as well as a pickup in the India business resolution of US FTA issues. If you look at the stock, it has already lost over 20% from its 52-week highs. It's trading at around 36 times 1 year forward, or 21 times when you talk about the FY24 estimated PE, and around 15 times when you talk about the FY25 estimated PE.
Okay, all right. Ekta, thank you very much for that. Let's straight away get to the first corporate on trading hour then. Narayana Health has delivered a good second quarter. The company has posted a revenue growth of more than 20% on a year-on-year basis. Margins too have improved both sequentially and on a year-on-year basis. To discuss the quarter gone by, the outlook going ahead, we are now joined by Sandhya J, the Group CFO of Narayana Health. Good morning, and thank you very much, ma'am, for joining in. Let's talk about the India business, which has seen about a 19% year-on-year revenue growth. Could you tell us what were the occupancy levels, the average revenue per occupied bed, and what is the outlook on these two parameters for the second half?
Sure. Good morning, and I really like the way you said good morning, girls. And starting with the India business, I do want to clarify that we did have some one-timer impact in the India business. So there is about 1.5 to 2% impact in the EBITDA because of the one-timers. We have clarified that in our results also, but just from a clarity point of view. Having said that, I think the first is, like we have always said, we look at revenue per patient as a better measure than looking at, ARPOB, because we feel that the patient communicates with the healthcare organization in multiple ways, and everything is not bed-driven. If you look at our average revenue per patient, it has been similar to Q2, if you would say. But I think where we have got the benefit or the tailwind is that one, we've been able to significantly improve the footfall and the case mix. We have also been able to improve the payer mix and the throughput with the patient. So that I think has given us the benefit. Now, from a utilization point of view, normally healthcare utilizations are around 60%. That's how they get reported, and we continue to be always in that range, 55 to 60%. But again, we need to understand that utilization as a metric does not really take into account some of the daycare volumes. See, we do more and more advanced procedures. A lot of robotic procedures is a morning walk-in, evening walk-out. So the way we look at utilization and some of those metrics is also evolving. But I think we've been able to deliver a better throughput. As you know, we've not added too many beds. So we've been able to do a better throughput in the same infrastructure.
But ma'am, if your case mix is improved, the throughput is improved, should it not result in higher average revenue per patient? Because you said that is flat on a year-on-year basis in Q2.
Yeah, that is true. So what also happens is that, see, the way we work with volumes with patients, and we are extremely conscious in what we charge to our patients. So from that part, we have always been able to create more value for our patients, more services, more enablement within the same, payment that they make. So it also is a reflection of some of the efficiencies we are able to make available to our patients.
Sandhya, hi, good morning. The hospital revenues, right, overall for the industry were expected to go up in this quarter purely because electives have improved. Medical tourism is expected to come back in a big way. So I'm just trying to understand going forward, the average revenue per bed as well as the occupancy, what could the rate be since there has been such a big pickup in demand?
Sure. So I think we have to wait a couple of quarters to give a guidance on the average revenue per patient, because there is significant pressure on the cost side. There is tremendous volatility from the cost point of view. One is, of course, the currency is playing a major impact, and we are aware of that already. But also there are delays, supply chain disruptions, which the healthcare organizations are battling with. So we also are going through our pricing exercise at the moment, and we try our best not to pass on the impact of such cost escalations to our patients, and try to keep our prices as affordable for our patients as possible. But we have to see how that impact actually takes effect to be able to give a forecast on the how the revenue per patient will move up. Obviously, you will have the effect, like you said, the effect of better volume, better throughput coming through. Some of it we will pass on back to the patient, and some of it you will be able to see in the numbers. But I am not seeing that number significantly go up, at least in our case, because we believe in value for the patient as much as for us. So that is the first aspect. The second question was on utilization, right? So on utilization, like I said, there will be two parameters. One is that we are investing significantly in digitization, and that has started giving us a lot of results in terms of how fast we are able to discharge patients. One of the reasons why utilization numbers also come in a little lower is because the turnaround at which we are able to churn patients and bring them and is linked to various factors, some of it internal, the processes in the hospital, some of it external, like approvals from insurance, PPA, etc. So we've been working significantly, we're working very hard and significantly cutting down the timeline which takes internally for the patient discharge. We have digitized the entire workflow of the patient discharge.
We got that. Sandhya, Sandhya, we're just trying to get to some numbers here. We got that. If you can, help us with the margins, because in spite of all of the cost pressures that you are mentioning, your margins did improve to 6.5%. So I want to know, A, what kind of levels can we expect margins to be at going forward? And also, if you can take us through a breakup of what the mature businesses are looking like, as well as the new hospitals, if you can break that up for us as well.
Sure. So first is in terms of the margins, I think there is about a 2% one-timer effect in the margin, like I explained. We were able to successfully renegotiate some of our contracts, which gave us some one-timer effect because of the accounting entries. So that is not sustainable. It will not repeat. Secondly, if you remember in Q1, we had reported a weak result in our Cayman business because Cayman was going through a COVID wave in Q1. And because of that, we had a shortfall in revenue and consequently in margin in Cayman, and that came back. So some of that effect is there in the baseline. Q3 is for all healthcare traditionally a slightly weak quarter because of the festival seasons. Like in October itself, we had Navratri and we had Diwali, and these are lower volume time for healthcare. So we will definitely see some slowdown in Q3 from the highs of Q2. But a lot of the improvement which has come in the margins, the underlying numbers are sustainable. So I do think that maybe, I don't want to put a forward guidance, but roughly half of the improvement probably is sustainable. Half of it is there will be seasonal impact and the one-timers will go away. As far as the new hospitals are concerned, in the last quarter, Q1, our new hospitals had turned EBITDA positive. Now we continue to be EBITDA positive in the current quarter. The new hospitals have delivered north of 8% in terms of EBITDA in the current quarter. And I think we will build on from here, subject to the quality impact.
Sure. We've actually run out of time, but thanks a lot for joining in and speaking about Narayana Health. All the best for the quarters to come. That's the word coming in from Narayana Health. But let's do one thing. Let's slip into a quick break. Up next, we'll discuss the massive carnage in the commodity space, especially in cryptocurrencies. More on that coming up with Manisha Gupta. Stay tuned.
Welcome back. You're still tuned into Trading Hour. And as promised, let's talk about the commodity space now. Manisha joins us and she's going to talk about copper after talking about cryptos for much of the morning. Manisha.
Well, yes, thank you for that, Pavitra. I'm looking at metals because we've seen some strong gains continuing here. And within the space as well, copper is trading at around 4-month highs. This is because of the mining disruptions that have been reported in Chile and Peru. There are US sanctions now on Russian production that has been adding premium to prices also. And then China is expanding key financing programs to the real estate to the tune of nearly 250 billion Chinese yuan. So that is clearly, that means that the real estate sector, the construction numbers would see an improvement, and that would lead to more copper demand in case of China. The LME copper stocks also trading at around 7-month lows has been supportive for prices. We've seen LME inventories decline by nearly 44% in last 1 month alone. The Chinese copper inventories also are near record lows, and that has been supportive. The major cues clearly continue to come in from China, where we have seen China being a top user of copper. When you look at the production and imports of China, that has seen a bit of a decline. So the markets do believe that the total inventories within China are on the weaker side. The on-spot premiums have been rising, suggesting that on ground, the demand seems to be getting better right now. The car sales, while they did miss expectations in the month of October, the November numbers, the first 10 days have been slightly on the positive side. But of course, it is going to be about the COVID cases in China, the zero COVID policy. That is something that the markets keep looking at, and that is what is weighing onto the prices at these current levels as well. It's all going to be about the US inflation data today. Markets will take further direction from that.
Okay, Manisha, thanks a lot for that. Well, for now, the market is actually not too bad. It's not gotten worse. It's only the mid-cap end of trade where there's a slight bit of pressure accelerating down over 300 points for the mid-cap index. And the market breadth has gotten worse, but the headline index is still where it's at, holding at about 18,000. Let's slip into a quick break. When we return, we have the management of Stovecraft to discuss their quarterly numbers. Stay tuned. Welcome back. As promised, we have the management of Stovecraft with us. It was a strong quarter for them. Revenues grew 12%, profits rose by 13%. And we have Rajendra Gandhi, who's the managing director of Stovecraft, joining us now. Mr. Gandhi, good morning and thanks for joining us. Good quarter is what you had. People buying more pressure cookers perhaps that they haven't for the last 2 years. But tell us a little more about the demand trends. What kind of sustainable growth do you see in the second half of the year?
Yeah, we had a good quarter, and it was the comparable quarter for the previous comparable was also good. So I can say it was a good quarter compared to that equally good quarter. And we continue to see similar demand that we have been experiencing in the first half. And there is an advantage of material cost, the input cost stabilizing. With this, we see that both on revenue and margin, we see that we can continue to be at the stable, steady growth that we are witnessing at the moment.
Mr. Gandhi, can you talk about the guidance that you've laid out? I think 10% volume growth for the second half of the year, revenue growth of double-digit, and EBITDA margins at 11%. Can you tell us what went into this guidance?
We believe that we are growing at this pace already. And of course, like I mentioned, the quarter bygone was comparable to a good quarter of the previous year. And we continue to grow as we have been in the past few years and several quarters. So, and the demand continues to be at the same level. And more of manufacturing, more and more of manufacturing is giving us a more advantage to pass on the benefits to our consumer. And so we are getting more competitive advantage in each of these products where we are able to get into manufacturing or getting into backward integrating of these products. So we are becoming more and more competitive. We believe that both the market is also growing, but we are growing a little more than the industry growth because we are able to pass on the benefits to the consumer.
Okay, good morning, Mr. Gandhi, and thanks for joining us. So you hold your guidance that you had given earlier for FY23?
We can say that we will grow at a good double-digit growth over the previous year.
Okay.
And that's what we have been maintaining.
Okay, good double-digit growth you can grow at for FY23. You were also talking about how commodity costs have come down, and even compared to last year, there has been a decline, but it's not really showing up in your margins. Is there a significant change in the pricing?
We did not take a hike in the second quarter.
Okay.
With the same price, we are able to retain more or less the margins that we have had in the previous comparable quarter. There was a decline in the margins in the last 2 quarters of last year because of high pressure on cost. But because of the stabilization of these costs, we believe that we can maintain the same margins that we currently have.
Oh, you can maintain the margins, what you said?
The current margins that we continue to have.
Okay, so about 11.6 to 12%, right?
Yeah, we will protect the 11% margin is what we are working on.
All right.
And the business definitely has to be positive of that 11%.
Sure. You protect the 11% margins. I want to understand a little bit about the consumer electrical segment, because over there you recently acquired Scava and you're looking to expand in this whole, LED bulbs, switches space. It's a very competitive space. Want to understand what kind of growth do you see there and what are the sustainable margins there?
Margin is, for us, any product or channel, we have the same margins. It is product and channel agnostic. Whether it is the LED lighting business or the new Scava range of products or our regular cookware and appliances range of margins for us as a brand is the same that we maintain. On the growth, I can say that the Scava team is now fully integrated and we have started making the products under the Scava range. Apart from our LED lighting business, we are also witnessing good demand, good growth in the lighting business. It is relatively higher than the company's growth rate. And coupled with the Scava range, we will see that we classify this as the LED range, the lighting range for us. So we will see a higher growth rate in the LED business compared to our overall company's growth.
Could you tell us your plans to expand your distribution footprint to any new product launches that you've lined up?
We are in several of these categories that we operate. We continue to offer new product and new models. Apart from this, the new launch that we have recently tested in Kerala was the induction cook. I mean, sorry, it was the air fryer that we launched, and we saw unprecedented kind of acceptance from the market, from the Kerala market, and we are rolling this out to the whole country. But in the various categories of products that we operate, we continue to innovate and give new offerings to our consumers.
Okay, just another question I wanted to ask you was that in Bangalore, you did open a new store for the Pigeon brand. I know that you're looking to open 40 more. Can you take us through the kind of capital that you will need for this?
Last time when we had only one store, now we have 18 more already, and we believe before the end of this year, we'll be able to open up to 40 stores.
Okay.
The capital generally goes into three buckets. One is for the rental deposit that we pay, the interiors that we invest on, and the inventory that we stock at the stores. It is on an average of about 15 lakhs per store.
Okay. All right. All the best. Thanks a lot for joining in. That's Stovecraft. Decent performance last 3 months. The stock is up almost about 15% and not bad in terms of earnings as well. Let's take a short break. Up next, Rishi Kohli, the CIO hedge fund strategies at InCred Alternatives, will be with us to discuss the way forward for the market.
Welcome back. So holding on to that 18,000 mark, though the benchmark indices are down about 0.6 of a percentage point. The Nifty lower by 120 points. The Sensex down nearly 400 points. Rishi Kohli, CIO hedge fund strategies at InCred Alternatives, is now joining us on the show. Rishi, morning. Rima here. Thank you very much for joining us and making your appearance on CNBC-TV18 after a very long time. You're just in the process of launching your fund. You have a hedge fund strategy. Can you walk us through the approach that you're going to be taking when you deploy that money? What is the opportunity that you see in the Indian markets right now?
Sure, thanks. Yeah, so the first fund that we'll be launching in a couple of months is more focused on market neutral and low risk consistent return strategies. Basically, over the last year or so, in various other media interactions, I have been saying that this year, markets would not be easy, and they would not be fully directional on either side, and there would be more opportunities for market neutral strategies. It's largely been playing out that way. I think over the next 6 to 12 months also, there will be a good scope for market neutral strategies, which basically means that you are going long futures and short futures, maybe stock versus stock or Nifty stock versus Nifty, and therefore getting some relative alpha on the futures side. And similar strategies on the option side also, you can have low risk strategies and get returns. So I think it's a great environment for these kind of strategies and to get low risk, low net exposure based returns. So that's what the fund will focus on. Having said that, of course, markets from a short term perspective have been difficult. From a medium to long term perspective, still look bullish broadly.
Sure. Rishi, hi, good afternoon. I was going through your the list of preferred sectors, and within that, PSU Bank tops the list. Now, there's been such a big rally already. Do you think it's still just a trading move here? And what is the recommendation for viewers watching you right now?
So I think, their PSU banks are coming out of a 10-year sort of bear market, right? And have done well over the last year, largely. So I think there's a lot of scope. It's sort of a secular move. A lot of the cleanup has happened from a fundamental perspective and from a technical and cycle perspective. Like I said, they're coming out of a 10-year bear market. And when that happens, then typically the sectors will be in flavor for the next 3 to 5 years. So that's the very long-term view. From a short-term perspective, yes, in the very near term, over the last month or two, some of the stocks have rallied hugely. So I think they're due for a halt now. But as they halt or as they retrace some of those gains, I think it will be a good time to enter again for that next 3 to 5 year story that I'm talking about.
All right. Hi, Rishi. Good morning. This is Pavitra. You know, another space that you like is the IT sector, and it's amongst your top sectoral picks as well. Do you think much of the pain in these stocks is already in, and now we're going to see some kind of a turnaround going forward? I know, I mean, in the past couple of days, of course, they have rallied post their earnings, but do you think it's all upwards from here?
So that is more of a short-term sort of view.
Okay.
Honestly, we run a very interesting sector rotation model where we pick 4 sectors, every month, and we bet that that could outperform the Nifty. And on a consistent basis, that average of 4 sectors has been doing that. So within that, IT had come up for this month. But having said that, these are monthly rebalancing sort of quant strategies. So it could very well exit the next month, for all you know. So there's no big medium-term secular view that is emerging there. I think the worst of the decline has happened for sure. It also corroborates well with the overall way the US markets and the Nasdaq has moved as well. But I think their best period has gone by. And therefore, sectors like banks, autos, etc., I think from a medium to long-term perspective will continue to outperform IT, which remains a short-term bet for now.
What about metals? What's driving your optimism on metals? Is it the fact that we've seen a sharp decline in the dollar index and you think the dollar index is going to be lower? What's the call?
Yeah, broadly, the dollar index definitely seems to have peaked out for now. I'm sure there'll be some volatility here and there because after such large moves in the currency, they don't just head the opposite direction in a very smooth manner. So expect some volatility. But having said that, yes, the dollar index seems to have peaked out. A lot of these metals globally, also on the commodities side, have had sharp declines and have found good supports now. So I don't think they'll have much sharper declines from here on. And from a sector perspective or stock perspective in India, a lot of these have, again, similar to PSU banks, broken out of very long-term channels and cycles. And typically, that sort of becomes a medium-term secular story for the next couple of years, as I was saying earlier. So something very similar would happen in the metals, according to us. Of course, very volatile sector, but typically we consider it a cyclical. But something seems to have changed. Obviously, I'm not a fundamental expert, but putting all of this together, again, it's come up for the short term as a short-term bet, but it keeps coming every few months. So it also sort of corroborates the medium-term bullish view on it.
Okay, the other space is autos. It's also coming out of a long bear phase, right? At least a decade or so. But now, do you think there's a structural up move here? I'm asking because fundamentally, a lot of things are still awry. If you look at names like Tata Motors, I mean, there's so many challenges in the global markets. What do you do at a time like this?
Yeah, so again, broadly speaking, from a long-term cycle perspective and long-term quant perspective, things that have, not done well 5-10 years and then are coming out of it, but giving very strong momentum signals, very strong breakouts from those very long-term channels. All of that combined makes them sort of the best bets for the next few years. There's a lot of, data that we've crunched locally, globally as well, which sort of confirms those kind of factors. So on the basis of that, again, autos came up a few months back, since then have done very strongly, but it seems to be more of a 3 to 5 year play. Of course, there'll be pockets of over and under performance, and different sub-segments within the sector will do better or worse. But overall, the sector will do well. And I think, four-wheelers overall are, relatively looking better. Some of the auto components are looking better. Two-wheelers are a bit mixed as of now. But overall, the sector, yes, is among the top ones.
All right. Overall, the sector is amongst the top ones. Rishi, thanks a lot for joining us. We're going to leave it at that today, but we hope to have you back on the show soon and we can discuss some more ideas as well. With that, let's move on and talk about a corporate. Godrej Properties reported its Q2 numbers with a decline in sales bookings and volumes on both a sequential basis as well as versus last year. But the company did see an increase in its collections this quarter. Earlier, my colleague Sonal caught up with Pirojsha Godrej, the executive chairman of the company, and began by asking what he thought could have led to this weak operational performance this time around and what the outlook is for the second half of the year. Listen in.
We would have, of course, liked to do a little bit better this quarter, but I think overall the first half of the financial year has been very strong, and both the comparative quarter, as in Q2 of last financial year, as well as Q1, were relatively high sales quarters. So I think the performance in the second quarter was reasonably solid, though we would have liked it to be a little bit better. But for the first half of the financial year, we've grown bookings by about 60%. And have achieved just under 5,000 crore of booking value. Our full year guidance was to do a 10,000 crore booking value number. We feel that we're well set to achieve that and hopefully exceed it. So feeling very good about the financial year as a whole. If we are able to get to that 10,000 crore number I mentioned, that will represent a growth of 27% year on year. As you rightly pointed out, collections grew quite smartly during the quarter to just under 2,000 crore, and our operating cash flows from being just over break-even in Q1 were about 720 crore positive in the second quarter. So overall, I think operations were reasonably strong. We do expect, as is usually the case, for the second half to be considerably stronger than the first half of the financial year. So hope to, as I mentioned, get to that 10,000 crore number. And equally importantly, I think it's a very important year for business development. We've set a minimum expectation of adding new projects with a total booking value potential of over 15,000 crore for the full year. So far, year to date, we're at about 6,000 crore. But given the business development pipeline, we're very confident of achieving that 15,000 crore goal.
Okay, so 9,000 crore rupees is what you're expecting in the second half in terms of business development. In that case, I specifically wanted to ask you about the Mumbai market because that has been doing well for all the realty companies. But for you, on a quarter-on-quarter basis, bookings have come in at 565 crore rupees, which compares with 1,000 crore rupees in the quarter gone by. What happened here? Is it because of delay in execution of projects? Is it because of lower demand? Can you give us a macro view as well?
No, not at all. Actually, we had two big launches in the first quarter. So we had our best ever quarter for sales in Mumbai last quarter. So I think it's just a base effect. If we look at the first half sales in Mumbai, they would have grown by, I don't have the exact figures, but probably doubled over the previous financial year. So I think the Mumbai growth story for us is intact, but we did have two big launches in Q1, which of course skews the quarterly performance. But I think we're very confident of delivering very, very strong growth in Mumbai this year, alongside the other focus markets we have of Pune, Bangalore, and NCR.
Okay, so you are talking about 15,000 crore rupees of a pipeline in terms of business development. 6,000 crore rupees is already done. What does it do to your capex plans and debt in particular? Yes, I know debt equity is still below that 0.1 mark, but absolute debt has risen. Will you continue to invest? And in that case, what would peak absolute debt look like for the company?
Yes, we'll certainly continue to invest. I think, we did a QIP last financial year to ensure that we were well capitalized and that the balance sheet had the capacity to significantly invest, because we did believe the real estate cycle was turning and that any projects added over this period were likely to be very lucrative ones for the company. We've typically been comfortable with a net gearing of anywhere from 0.5:1 to 1:1. We're currently at 0.16:1. So I think that indicates to us that there is significant capacity for further investment. And we would like to see at least another 5,000 crore of net investment into business development take place over this next 12 or so months.
Okay, interesting. So in a scenario that we are in right now, Piroj Shah, are price hikes still on the cards? That is something we saw in the last year, last few quarters. Do you think that will continue for bigger players like yourself? And have you seen more market share gains? Of course, we've been talking about consolidation, but has that story continued? Because in tier 2 cities, we are seeing that smaller players are also starting to do well.
I think the consolidation story is very much intact. Of course, as the sector starts to do better, as it has over this past year, a lot of developers will see improved conditions. But I think most people are seeing the stronger developers growing very disproportionately compared to the rest of the sector, given the inherent advantages in access to capital, access to customers, and so on. And I do expect that trend to continue. We've seen in our own results, as I mentioned, a 60% growth year on year in the first half. We expect similarly strong performance in the second half of the financial year. And we can see that the trend of leading developers gaining market share is one that has been consistently evident over the last 5 years. And we expect will continue to gather steam over these next few years. And as I mentioned, given the kind of business development activity we're seeing, we do see the ability to grow the company ahead of market growth levels.
Okay, and what about price hikes in that case? Industry is still looking at steep price hikes, or you think this is done for now, at least considering that interest rates are also being hiked?
I think it's a dynamic environment. We'll have to see how inflationary pressures play out, how interest rates play out. But my sense is that usually what happens in property market cycles is that in the early stages of the cycle recovery, the recovery is more apparent through volume growth, as we've seen over the past couple of years. But that at some part thereafter, you usually do see relatively sharp price increases. We have seen some price increases, but I think so far it's been more to pass on the kind of inflationary activity that's been evident. But I think we will see significant price increases over this next 3-4 years. One has to keep in mind that while interest rates have increased over the last 6 months, they are increasing from an all-time low base. And even if you look at mortgages today at 8 to 8.5%, that is quite low by historical standards. The last time we were in a boom period about 10 years ago, interest rates for mortgages were at about 11%. So I think affordability for residential real estate remains quite strong by any historical comparison, with the possible exception of last year. And unless mortgage rates start inching into the double-digit territory, we don't see them as likely to cause too much damage to demand at current levels.
All right, that is the management of Godrej Properties. They are saying that H2 of this year will be better than what we saw in the first half. They're also on track to achieve their booking value of 10,000 crores and also the gross developable value for FY23, which is at around 15,000 crores. But with that, we're going to get into a short break now. When we come back, we're going to talk about some key earnings which are due today. The big ones are Eicher and Bata. So stay tuned. We'll bring you the estimates. Welcome back. You're still tuned into Trading Hour. For the market, we're currently seeing a 110-point cut on the Nifty, so 0.6% lower there, and some of the pain also coming through from the Nifty Bank, which is down around 0.8%. But we do have some big earnings to track today. So let's talk about Eicher Motors first. Sonia, what can we expect this time? Good quarter?
There is a new meteor, right? We were talking about that, how the spy shots have come out of Royal Enfield. Yeah. Before that, the Hunter has done so well that it's expected to reflect in this quarter's numbers, and hence expecting a very good set of numbers from Eicher Motors. The domestic recovery is aided by the success of the Hunter. It's also aided by the improvement in the semiconductor supplies. There's a ramp up in exports which has been very strong too, and there are price hikes that the company has undertaken. There's positive operating leverage which will aid the margins. The Royal Enfield volumes this time, including Hunter, has grown almost 68% on a year-on-year basis, a little over that, at 208,000 units. So I'm expecting a very good set of numbers. Revenue growth of 57%, EBITDA up 82% year-on-year. Margins will improve to 24% versus 18.4%. But let's not forget, same time last year was an aberration because of the semiconductor issue. So the stable state margins for Eicher Motors has been in this range of around 23 to 25%, and they're going to get back to that. Normalcy will return, and the profit growth of over 80% is what we're expecting. So good set of numbers expected from Eicher.
All right, let's also talk about Bata. Will they put a front foot forward this time? Mangalam is joining in with the expectations. Mangalam, the earnings from Relaxo were a big disappointment. I know it's not really comparable, the price point they're operating at, but can you walk us through the expectations from Bata?
Well, from Bata's standpoint, it is expected to be a good quarter, much against what the street is expecting for Relaxo, or what Relaxo reported, and that's primarily on account of a couple of factors. One, the base is low. Secondly, a large part of Bata's footwear comes in from the back to school, back to office and comfort footwear sort of segments as well. So those will be doing well. And from a strategy perspective, Bata has also moved to the comfort, smash, sneaker and casual wear, etc. as well. So as a result of which, that the numbers should look good on an extremely low base. 29% jump in the company's revenues is what the street is working with. EBITDA growth of almost 68% and a net profit jump of almost 143%. The number you're looking at is close to around 90 crores as far as the street's estimates on the bottom line of the company are concerned. What will be extremely crucial to watch out for, however, is what the company has to say with regards to the second half of this year, the festive season performance, any sort of cooling off that we've seen in raw material prices, the way they are expanding their stores, and the third quarter itself, which is the festive season, that's something we'll be watching out for.
Okay, thanks a lot for that. So putting its front foot forward, Bata later today. Let's step into a quick break. On the other side, we'll get you an update on the market. Stay with us. Welcome back. Well, not much is happening in the markets, to be honest. Looks like people have already taken the day off to go and watch the match, which about in an hour from now, all the action's going to begin. But in terms of individual stocks, some of them do deserve mention. The PSU Bank rally is not over just yet. Look at Union Bank, another day running. It's bucking the trend, and how? Up almost about 4%. And you have a couple of others that are joining the list. Something like in Indian Hotels, Amara Raja, Sun TV are a couple of other names that are looking pretty smooth this morning. But other than that, the action is on the lower side. Cash market volumes are not too high either, just about 25,000 odd crores. But just keep an eye out on the mid-cap index. That one is under a bit of pressure. But it's curtains down from all of us on Trading Hour when we come back, halftime report.